Today we're going to talk about income tax planning. Income taxes, fundamental part of the financial planning process, and we could learn a lot about an individual from their tax returns. So that's usually one of the required documents that we look at. And even though as financial planners we are not CPAs, we still have important roles to play as it comes to income tax planning. So let's get started. There are three different types of income, and this should not be new to you. We have active, sometimes called ordinary income as well, portfolio income, and passive income. So it's important to understand the categorization of income for a couple of reasons, and mainly because they're taxed in different ways. They're taxed at different rates. And there's also something called a bucket rule, which limits a taxpayer's ability to write off losses in one income bucket only to the gains in that same bucket. So there's a little bit of tax loss harvesting, and that's an advanced portfolio management strategy that a lot of financial advisors and investment managers, etc., use in order to minimize taxes on portfolio incomes. So two important reasons for the categorization of income, and it's really important for you to understand the difference between them because of how they're actually taxed. Different types of methods for accounting, right? So cash method, accrual method, hybrid. This is really important when it comes to small businesses, because once you identify yourself in one particular method, you tend to want to hold on to that. In particular, the most common approach is the cash method, where income is taxed when it's received and deductions are claimed when they are paid. Okay, accrual method is a little bit more sophisticated. Your income is taxed when it's earned. So for example, it's 2016, you get a sales order for a particular job, although you have not received the cash until 2017, you would record it as income in 2016. So it really depends on your flavor and your preference, but usually majority of people defer to the easier method, which is the cash method, and just it makes sense. So I get the cash this year, I record it this year. If I spend some money next year, I record it next year, and that just makes things simpler. But once you've identified yourself in one particular method, you may want to continue with that method for simplicity of taxes. So I always get the question, Professor, I don't think I should file taxes, or I don't think I have to file taxes. Well, the government disagrees. So failure to file is it has its own section, 6651, and it's imposed on taxpayers who fail to pay the tax due on the due date. So if you don't file, your chances probably you even had a refund to get. A lot of students, that's true. Maybe some earned income credit, which we'll talk a little bit more about later. But you'll never know unless you file. Now, if you owe taxes and do not file, well, here's the consequence. Right? There's a consequence as outlined on the section 6651. And even more so, it's not just failure to file, but it's the accuracy of the filing. So an accuracy-related penalty is imposed on taxpayers who file incorrect returns as a result of failure to make a good faith effort to comply with tax law, substantial understatement of tax liability, substantial valuation on the statement, substantial estate or gift tax valuation on the statement. So not only do you get, possibly can get a penalty for non-compliance, for failing to file, you could also get one for filing incorrectly. So that's definitely something to note. So the penalties, what are they? All right, so if you fail to pay, if you fail to pay, you will be assessed 0.5% per month or part thereof to 25% maximum. Accuracy related, if you have underpayments, it's 20% to 30%, or 40% if due to substantial valuation misstatements. And if it's fraud, it's 15% per month up to 75% of underpayment. So these payments are very strict. They're very strict, and these penalties could really add up and they're going to accrue, and the government doesn't play when it comes to its money. So when you're dealing with taxes, you have to be extremely careful and understand the significant difference between tax avoidance and tax evasion. Failing to pay or fraud or something to that effect may come off as tax evasion. However, there are legal ways outlined by the tax code and law. So what's the tax formula? Income minus deductions equal taxable income. Is it that simple? Is it really that simple as income minus deductions equal taxable income? Well, actually it is, but understanding what these deductions are extremely important. And then how do we get your actual tax owed? Then we take your taxable income by your tax rate. So the tax rates are very different year to year. The tax rates change every year. And these ranges either increase or maybe decrease depending on who is in the government. So we definitely need to pay attention not only to our marginal tax rate, but overall what deductions and or credits we could qualify for. So here's a worksheet. You'll go through this. You'll get above the line deductions, below the line deductions. We're going to talk about that a little bit. Personal and dependency exemptions, and then you get some credits applied at the back end, and then that determines your taxes due or the refund that you actually do. So you could download a worksheet like this offline. The tax calculators online as well, but this is the process. Think about this process, and this is in your book, so definitely revisit this. And if you're, for example, in the cases that we have to do, if this is something that you're asked to identify taxable income, you could find it online. Now you might just want to go through the exercise of calculating it yourself, or maybe this is how you could simply do it for your own personal benefit if you want a projection. But you could use a 1040 simulator online as well and get a good sense of what the taxable liability would be. So what's income? What's counted as gross income? So income, broadly defined, means the gross amount of money and the fair market value of property, services, or a creation of wealth received. So gross income includes all income items that must be reported on the federal income tax. Examples of this: income from rental property, if you get unemployment, if you have royalties, if you're getting paid alimony, if you're self-employed and you're set up as a sole proprietor or LLC and you're the managing member or shareholder, then that's one way. Dividend income, but remember, income can be split into 3 categories. Remember what they are, because they have direct result in the way they are taxed. So we also have exclusions. You could exclude certain things from your income. And this is by no means an exhaustive list, but here's some examples. If you receive child support, that's excluded from income. A cash or property received by a gift, that's excluded from income. When you put money into your retirement plans, and I must say here, qualified retirement plans such as a 401k or 403b, interest income on municipal bonds, that's also excluded. Scholarships or fellowships are excluded as income. Life insurance proceeds received because of the death of an insured, so the death benefit from a life insurance contract. And these are some of the things that definitely we want to remember, because that's how some of the things that we will exclude from our income, and especially above the line type of calculations. So this will help to reduce or lead us to our adjusted gross income. In the case of, for example, where you're going to see on your paycheck would be the deferral contributions to certain retirement plans if your employer does in fact have a retirement plan. So just a little bit more about deductions. So deductions are subtracted or helps to reduce your gross income, and that gets us to our taxable income. Remember, income minus deductions equal taxable income. So we can divide deductions into 2 groups: above the line and below the line. You've probably heard this before. Above the line or below the line. So deductions for adjusted gross income, deductions for adjusted gross income are called above the line. Deductions from adjusted gross income are called below the line. So here is a partial list of deductions for adjusted gross income, rather above the line deductions. So if you are divorced and you pay alimony, that's an above the line deduction. Tuition for higher education, interest on student loans, contributions to IRAs, business expenses, moving expenses are above the line deductions. Now on the below the line deductions, I apologize for that. On the below the line deductions, we will get a little bit more into here, but make sure you understand what's above the line and the types of deductions that come above the line, because that leads us to that adjusted gross income figure as we're trying to calculate our taxable income overall. So how does it look? We have gross income, we have exclusions, right, and the exclusions we just talked about. Then we have the adjustments, which is the above the line, and that gives us our AGI. And when it comes to the below the line deductions, you usually see it as either a standard deduction or itemized deduction, and we're gonna get to that in a little bit more. Above the line deductions reduces a taxpayer's gross income. Above the line deductions can be claimed by the taxpayer even if the taxpayer does not itemize. This is a significant difference between above the line and below the line. So even if you don't itemize, you could still take your above the line deduction. But when it comes to the below the line deductions, it's either or. You either take a standard deduction or you have to itemize. The deductions are also referred to as the itemized deductions. And here's a list of them. Some of the most common ones, state and local income taxes. Now in Texas we don't have that, so we get to deduct our sales tax. Right, so if you keep all your receipts for the year, you could actually go and deduct your sales tax because we don't have an income tax in Texas. The home mortgage interest, that's another common one. Home mortgage interest, it's also a below the line deduction. Charitable contributions, which is better, above the line or below the line? Essentially above the line I usually thought of as more favorable on a dollar for dollar basis, because when you get to the below the line, you know, it's itemized, right? So not everybody will benefit. You have to reach that threshold for itemization. So if you're married, well, you have two standard deductions that are layered on top of each other to get you over that threshold. The standard deduction, this is what most of us actually get. The standard deduction is a standard amount used to offset AGI that is specified by Congress and is adjusted for inflation annually. So the basic standard deduction amounts depends on taxpayers' filing status. So that's really important to understand. Here's your standard deduction. Look at it. Who does the deduction favor? In a sense, here you could see married filing jointly. So when we file as single, it's actually one of the most unfavorable tax categories. Head of household is also a good one because you get the additional cap because of a child, right, or some sort of dependent. So that's really, really important for us to know. Look at it. The tax system favors marriage. It favors a family. So you see the government somewhat agenda here. And look at it. It's double the single rate. So that makes sense, right? But in lieu of that, you tend to have head of household. And even if your spouse dies in 1 year, they still give you that surviving spouse standard deduction as well. So an additional standard deduction is also allowed for a taxpayer or spouse who is 65 years of age or older, or who is blind. They get an additional deduction. So if you're blind or 65 and older, a senior, you get an additional deduction. And this brings us into the next step. If you remember that worksheet, after we talk about the standard deduction versus the itemized deduction, and you decide to go with either one, you're going to go with the one that is larger, of course. Then we have exemptions. We have personal and dependency exemptions, and these are deductions from adjusted gross income. So the personal exemptions allow for the taxpayer and the taxpayer's spouse. And here are the thresholds, they have cutoffs, all right? So if you're individual, your phase out for this exemption begins at $259,000. So once you make more than $381,000, you don't get that exemption. And marriage filing jointly, it's $433. So they get an additional $52,000. The dependency exemption is allowed for each person who qualifies as dependent, and I think the dependency and the personal exemptions this year are around $4,050. $4,050. When determining the tax on your income, your tax owed, we have a range from 10% all the way up to 39.6%, and it's a marginal tax bracket. So within a certain specified limit, you have one category that might be one range of income that will be taxed at 10%, and then that next range will be taxed at, say, 18%, and so on and so on. Right, so the marginal tax brackets also change, at least the threshold changes annually, but right now the current tax rates are from 10% to 39.6%. And we briefly talked about the filing status. The filing status is used to determine the amount of taxpayers' standard deduction. Alright, so here we have head of household, and there's including an abandoned spouse. So if you live in separate households, we have married filing jointly, surviving spouse, single, and married filing separately. Now, married filing separately could be as a result of one spouse just simply not having gross income. But so then in that case they'll file married filing separately, and may get an exemption to do a head of household filing because that spouse then becomes independent. Abandoned spouse, by definition, according to the IRS, status is more favorable than filing married filing separately. So that's what I was mentioning here. If you file as head of household, that may be because your spouse does not work, then having a head of household because of an abandoned spouse will actually give you that extra cap in your standard deduction, and that significantly impact taxes a little bit by a couple $1,000 depending on your marginal tax bracket. And the surviving spouse, as the name suggests, it affords the same basic standard deduction tax rates of married filing jointly status, but to be eligible, the spouse must have died in taxed year, right, found with the preceding two. So you get a 2-year window in order to actually capture that. All right, and I won't go through too much on the special rule for father of mother of taxpayer. You can read that, but single must be used by an unmarried taxpayer who is not eligible to use the surviving spouse, not the head of household filer, and it's the least desirable. So the tax code favors marriage. The tax code favors unionships and families. So you get an extra benefit from having a family. So you could see here that, and we saw this also, married filing jointly and single, the two least desirable filing statuses. So we have, when we're talking about credit for taxes withheld, once you get paid, you tend to have you fill out a W-4, and your company probably withholds some of your federal income tax. So it's sort of a prepayment, right? So rather than waiting until the end of the year, and you can do that, you could set your allowances to 100, for example, and never pay tax, but you will have to pay the tax at the end of the year. Okay, so this is like a commitment device. So we prepay our tax. So from that, when an amount is subtracted from a tax, it is called a credit or a tax credit. So the withholding is a prepayment of tax. So let's make that clear. When you withhold, is a prepayment of tax. So at the end of when you file your taxes the following year, you're either going to get a refund because you withheld too much, or you're going to have taxes due. When we're talking about tax credits or credits, We're talking about an amount that is subtracted from a tax. So let's assume this is our tax liability. Then here's a credit that's applied to Social Security tax, right? Social Security tax has a wage-based limit of $118,500, and that was in 2015. So if you make more money than this, you don't pay Social Security on anything above this level. But Medicare is not subject to a wage limit, all right? And this is FICA taxes. This is your Social Security taxes. And then we have the FUTA, which is the unemployment tax, which we also pay, but self-employed individuals do not pay this tax. And they have the self-employment tax where you have to pay both sides. So if you're working for a company, a firm, an organization, you pay half, the company pays the other half. When you're self-employed, the expectation is that you pay both. So you would pay 15.3%, all right? And this was reduced some years ago when we were going through the recession recovery, but it's now back up to its traditional limits. A little bit more on tax credits. So earlier I said that a tax credit is an amount that is subtracted from the calculated tax. Now there are different types. There are some that results in a refund. So even if you have zero tax liability, you could still possibly get a refund. And there's some that are non-refundable. So non-refundable tax credits can reduce the tax on a taxable income to zero, but you cannot get a refund. Whereas refundable, you will also generate a tax refund not in excess of tax prepayments if we withheld too much, or you might also get certain types of credits. You could get money even if you don't owe anything. All right, so when you're talking about the credit, how is it calculated? We have the tax on the taxable income minus the refundable credits will give us the tax due or the refund. Here, it's not even the refundable credits. You could also get the non-refundable credits that will determine our tax due. But if we don't have enough non-refundable, not enough non-refundable, tax on taxable income minus refundable credits will get us to our tax due as well as our refund due. So here's an example of a credit versus a tax deduction. So let's assume that we have a tax credit of $1,000. That will provide the same $1,000 reduction for a taxpayer in a 15% tax bracket. For a tax deduction of $1,000, it will generate a tax reduction of just $150. See, you multiply your tax bracket by the amount of deduction, and that's how you calculate it. So credits are a lot more favorable and desired than would be deductions, but deductions obviously still do help. The higher your tax bracket, the more important a deduction is to you, but tax credits tend to be a lot more given when it comes to the tax code and potential refunds. I want to introduce you here slightly to a topic of basis that is extremely important when it comes to transfer of property, either through life or at death, or what do you call it, your basis in a home and something that you purchase, right? So basis represents capital or after-tax income that the taxpayer uses to purchase an investment, all right? So that's your ownership. And basis is used to determine a gain or loss when the investment is disposed and when you sell it. It's used to determine depreciation deduction that an investor can take. And basis is also used to determine the amount an investor has at risk. What's your principal in what's your cost basis in terms that you potentially have heard before. And because we use our after-tax money, it wouldn't be to the fear if the government was to just tax the complete sale. So they will make an adjustment for our basis. How do you determine cost basis? You look at your purchase price, your sales tax, your freight, installation and testing costs, all costs to get the asset into operation. Your purchase price, your sales tax, your shipping, your installation, any costs All this is included in your basis. Now, your basis differs based on how you got it. If you bought it, your basis is the price, plus the other costs that we just described above. If you inherited it through life, right, it was a gift, then you get the donor's basis, plus any gift tax the donor has paid. So if you have to pay taxes on gifts over $14,000, right? So if the donor in fact has paid taxes, then that's included on the basis for the gift. The inheritance at death, transfers at death, is the fair market value at the decedent's death. That's the person that sends it to you, that gifts it to you, that inherits it to you, wills it to you rather. It's the fair value at the date of death. So understanding the different effects on basis based on the acquisition method, that's very important as well. But we have some adjustments to basis. How do we adjust basis? So basis can increase if additional capital is added to the investment. The cost basis will increase. Basis will decrease when the capital is removed from an investment. A basis reduction may occur because the taxpayer has received a refund or some of his capital. So if, for example, you've bought into a business and you put some money in, and then you sold a portion of your shares, well, your basis will actually reduce overall because you've received some of that initial capital that you've put in. And it's another important topic is the realization and recognition of taxes, or a tax generated action. So when we have gains on capital assets, these are subject to tax only when there has been both the realization or recognition for federal tax income purposes. So for us to have a gain, let's say we have a stock investment and that's going up, it's appreciating, until we sell it, it's unrealized. And realization occurs when the asset has been sold or exchanged. Recognition occurs when a realized gain is required to be included in the taxpayer's income tax return. So upon sale of said stock A, and your stock price has doubled, so you've had a significant return, when you sell it is when it's realized, and it's recognized when it's included in the taxpayer's return. But how we determine that gain is a function of time, and you should have gone over this before, so this might be a refresher. But depending on your length of time that you held that asset will determine your capital gain. So understand these two different holding periods: long-term capital gains greater than a year, short-term capital gains or losses less than or equal to a year. Okay, so long-term gains greater than a year, short-term capital gains and losses less than or equal to a year. So for property though that's acquired by inheritance, the decedent's estate is deemed to have a long-term holding period. So this is some estate planning aspects of it. And estate planning and tax planning is very important. And tax planning is very important when it comes to estate planning. So property acquired by inheritance is deemed to be a long-term holding. Gifted property, on the other hand, is a result of the donee's holding period, as well as the donor's holding period. So, if the person that gifted you the asset had it for 10 years and you held it for 5 years, then your total time frame is 15 years. Okay? So if you inherit it, deemed long-term. If you gift it, it's a function of how long the person that gifted it to you had it, as well as how long you plan to hold that asset. And the tax rates have changed a little bit, and obviously based on your holding period, you'll have a different tax rate. Capital gains tax rates is a function of the holding period, like what we just talked about, and the longer you hold it, the more favorable the tax terms. And when you combine that with your marginal tax bracket, there's sometimes when you don't even pay capital gains taxes based on your adjusted gross income. So here's an example that considers the sale of a mortgage, which is rather common in financial planning, especially amongst retirees who are using their home as a hedge for under-saving for retirement. So they may sell their home and move. You find that a lot of people from the northern US in much colder areas, they sell their houses and they move to warmer temperatures. In the valley, we call them winter Texans. So let's examine what happens when you sell your personal residence. So you must have owned and used the home as your primary residence for at least 2 out of the last 5 years to benefit from this. Must not have excluded gain on the sale of a principal residence within the last 2 years. Married must file a joint tax return for the year. Filing status must be married filing jointly, and both spouses must have used the residence for 2 out of the 5 years. And this is based on this case here of a couple, right? So the amount of available exclusion will depend on the filing status. So for married couples filing jointly, up to 500,000 of the gain is excluded. So your house could have gained 500,000 in value, it's excluded. For all other individuals, may exclude up to 250,000 from the gain. That's based on the filing.